We are back and we've talked about discretionary trusts, we've talked about fixed trusts, and now I wanted to move on to another one that is getting a little bit of airtime, companies. So, Leah, tell me why somebody would buy or why somebody wouldn't buy a property in a company name.
Okay. There's probably a little bit to unpack here, and I think it is a very unusual thing to purchase a property in a trading company.
Okay, so a trading company being a company that's actually got a business that's running money through it, not just a shelf company that we've set up to buy property.
Yes, that's
okay,
right.
So for you that would be Lift Accounting. So you're not going to go and buy a property in Lift Accounting's name?
Absolutely not, no.
Why?
Yeah, so the reasons why on that is every business holds risk.
Yeah.
We can all sit here and say, well, we've got our insurances and yeah, we do. We don't intend to go out there day on day and not have a successful business or get sued. However, every trading entity has its own risks.
Yes.
So I think from a pure asset protection concept, it's not a great idea to hold property within a trading entity.
Yeah.
That's a very generalised statement.
And would there be exceptions to that?
I think there could be. I think you can see some builders sometimes buying property, and I would view sometimes when they're doing things like that, it could be a show, like a display home that they're building, or their pure intention is a very quick hold. They buy, they reno, or they build and they flip it.
When I said is there exceptions, I was thinking builders in my head.
Yeah, so there can be, and that could still be a discussion if it's the right entity, but in the end, it's sort of seen as part of their business.
Yeah.
It's not it's not like me, in my accounting firm, I'm not
An accountant's not
property.
going to buy a property in their trading name, but somebody that's their core business, that could be an exception.
There could be the exception there, for that conversation. So if we just sort of park trading companies and think from an investment company.
So would that be just a company that you would create just to go and buy a property in?
Yeah.
Now tell me why I would do that.
Yeah, so again, generally my immediate reaction is like, no, it's not great. And the first reaction as to why it's not great is the 50% discount. So as most people listening would be property owners, and if we hold our property in our own name, all the trust structures that we were talking about before, and we hold that property for more than 12 months, then 50% of our gain is tax-free.
So just to go back to trust, we didn't cover that.
No,
so
we
if
didn't,
I owned a property in a family trust, discretionary trust, or a unit trust, and I hold the property for more than 12 months and then I sell it, I still get the capital gains concession.
Correct.
Fantastic.
Yes.
Okay, jump back to companies.
Yes. Now, yes, I didn't touch on that, so I apologise. Those entities definitely still access those concessions. A company does not.
Okay. That's a big difference.
It is a big difference, isn't it? So then also these investment companies will pay tax at a rate of 30% of tax. So I'm just raising that because, again, if there's any business owners like ourselves listening to this podcast, we've probably got 25% of tax in our mind. That's a trading entity tax rate for small business.
So a trading entity tax rate is different to a holding company tax rate.
Yes. Yep.
And so if I'm having a property that I'm holding a company in and it's getting a profit, I'm going to pay tax at 30%.
Correct.
Which is less than I might be paying personally, though.
Exactly right.
Yeah.
And you know what? I got challenged pretty heavily by a client on this because I was just saying he was wanting to start building his portfolio, and he was in his early 40s at the time. I'm like, no, we're not putting it into a company, and you're not getting your 50% discount. And we can all learn from everyone, right? So he kept pushing back at me, and when we really broke it down, this gentleman now has some property in a company. So
why did he do that? Tell me what was different for him.
Yeah, so where his mind is he has absolutely no intention of working until he's 60. He was earning very high income in his own name. So he was already in top tax rates personally. And he really didn't have any intention of them being negatively geared for long. So in his mind, if he ended up selling it, well, he will end up selling, but when he ends up selling at the company rate, he'll pay 30% of tax. He's okay with that because for all the years he's held it, he's also only paid 30% of tax on the earnings. He isn't living off that money. He's sort of seeing it like a pseudo super fund really, because he doesn't want to wait till age 60 to get these assets. So when he sells his business, which is going to happen very soon, he'll have the property and he's got all this cash in this company, and then we can filter it out to him in a very tax-effective manner as a form of income once he's sold his business and he's not on high marginal rates and he wants to live off that.
So you would say that buying in a company isn't for a lot of people, but people who it fits their particular strategy can be used.
Yeah, that's right. Yes.
Not as often as family or discretionary trusts.
Not as often at all, no.
Yeah.
Still good asset protection.
Okay, so you still
Very
get the full
similar.
Asset protection,
Yeah,
because
to
if
the trusts.
he owned that gentleman that you just talked about, he's got his properties in a company. If something were to happen to him personally, is that protected because he's in a company?
There's an extra layer of protection.
Yeah.
Yeah. I still think the lawyers would have to work pretty hard, depending on what the court
Yeah.
case was, of course. But there
And we've all
definitely
seen
more
things like
protection.
family court pierce the veil of
Yes.
those sorts of structures. That can definitely happen. So you don't want to lull people into a false sense of security, but you do have extra protection.
Yeah, that's correct. And I think when I'm talking protection, it's not necessarily from a family court style perspective. I think that's a pretty encompass all style legislation. It's more from, any legal actions
You're okay.
from creditors or being sued.
So if I was a plastic surgeon, would I be more inclined to buy property in a company?
I think you would be more inclined to buy property in not your own name. Yeah.
Yes.
You're in a very high risk, much higher risk industry than an accountant or a mortgage broker.
Yes.
Yeah.
So those sorts of industries might be more interested in asset protection than, I have to admit, it's something that I've never been concerned about. So I've never been worried about asset protection when I've been buying property. I'm worried about capital gains, land tax. I'm worried about borrowing capacity.
Yes.
But in what I do every day, I don't feel like I'm going to be personally sued for something. But if I was, I'm just using a plastic surgeon, plastic surgeon. But if I was a plastic surgeon, I would be more worried about that.
Yeah.
I'd probably want to have more things in place to separate me from my property.
Yes. Yeah. I think that was a great example. I know in speaking with clients previously, I've used the example of if you've got a horse riding school or, they're just industries that if something goes wrong, it's really gone wrong,
Yeah.
If I do a tax return wrong, I'll fix it. It's not it's not going to destroy anyone.
So it would be industry specific why people may choose to do companies, trusts and all those things if it was for asset protection.
Yes.
There's a lot of pros to these sorts of structures, as long as people understand all of the other things involved.
That's exactly right.
Now
It's really individualised.
Yeah.